Welcome to the Wealth Accelerator, where we help you turn strong personal finance fundamentals into rapid, sustainable wealth building. You have paid off debt, built an emergency fund, and started tax-advantaged accounts. In this video, we will map out the next strategic moves to accelerate your progress. First, we will clarify the right order of accounts and why speculation sets you back. Then, we will show how to supercharge retirement contributions early while fees stay low. Finally, we will pivot to the biggest lever of all: income growth. Stay to the end for a clear action plan, diagrams, and quick quizzes to test your understanding. Here is the plan for today. We will first align on your current position. Next, we will cover 3 critical steps: maximize tax shelters, boost retirement loading, and focus on income growth. Then, we will define your future with goal-driven timelines. After that, you will get an actionable plan, supported by diagrams. Finally, you will take quick quizzes to cement the concepts. Before we proceed, please note this content is for educational purposes only and does not constitute financial, tax, or legal advice. Your personal circumstances, jurisdiction, and plan rules may differ. Always confirm details, contribution limits, and tax implications with a qualified professional and your plan documents. You have completed critical prerequisites. You eliminated high-interest debt, set aside an emergency fund, and started using a tax-advantaged account like a Roth IRA. This places you ahead of the majority of people. Now the question becomes, what is the smartest next move to accelerate your wealth? In the next sections, we will prioritize the order of contributions, remove speculation, and lean into compounding and income growth. This first step is about order of operations. If you are putting money into a taxable brokerage before maximizing your 401k, you could be missing substantial tax advantages. Start by capturing the employer match, which is essentially free compensation. Then, increase contributions toward the annual legal maximum. Tax-advantaged accounts either reduce your taxable income today or give you tax-free growth and withdrawals in the future. After you maximize these shelters, only then should you add to a taxable brokerage account. Meanwhile, abandon the search for the next big stock. Historically, diversified low-cost index funds outperform most individual stock pickers over time while reducing risk and taxes. This approach helps you keep more of your returns and focus your energy where it truly compounds. This table outlines how different accounts are taxed. Traditional 401k and IRAs often provide tax deductions today with taxes due on withdrawals. Roth accounts use after-tax contributions and can offer tax-free growth and withdrawals if you meet the rules. Taxable brokerage accounts are flexible but less tax-efficient, since dividends and gains are taxed along the way. Therefore, prioritize tax-advantaged accounts first, especially if you can capture an employer match and maximize annual limits. Quiz time. The question is, what should you generally prioritize before investing in a taxable brokerage account? Option A: picking individual stocks for higher potential returns. Option B: maxing your 401k contributions and capturing the employer match. Option C: holding cash beyond a 12-month emergency fund. Option D: buying sector-specific ETFs for tactical plays. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to maximize your 401k contributions and capture the employer match. Prioritizing tax shelters allows you to reduce current or future taxes, capture free employer money, and benefit from tax-advantaged compounding. Only after these are maximized should you direct additional savings to taxable brokerage accounts. Next, accelerate retirement loading while time is on your side. Increasing your contribution percentage earlier leverages compounding for decades. If your income is currently in the mid-5 figures, a Roth 401k can make sense because paying taxes now at a lower rate may lead to tax-free withdrawals later. Make sure your investments are placed into low-fee index funds or target date funds. Even small differences in expense ratios compound against you over time. Additionally, consider front-loading contributions before major life expenses, such as a mortgage or childcare, start to absorb your cash flow. This way, you lock in a higher savings rate while it is easiest to maintain. This timeline highlights the advantage of beginning contributions early and increasing them as your career progresses. From ages 22 to 25, start at roughly 10 to 15%. By ages 25 to 30, raise to 15 to 20%, and evaluate the Roth 401k given your tax bracket. From 30 to 35, front-load contributions before major expenses like housing or childcare. From 35 to 40, maintain a high rate and set automatic escalations. Along the way, select low-fee index funds and remain mindful of expense ratios. Now pivot to the most powerful lever, your income. A 20 to 30% raise can outweigh weeks spent chasing small investment tweaks. Prepare for negotiations by documenting your measurable impact and aligning with business outcomes. Target high-return skills, such as data analysis, artificial intelligence tools, cloud platforms, sales, and leadership. Consider strategic role changes or certifications that move you up the pay curve. Crucially, channel the extra income directly into your newly maximized retirement accounts instead of expanding your lifestyle. This gap between earnings and spending is where wealth accelerates. On the left, optimizing fees saves meaningful money over decades. Dropping expense ratios from 0.6% to 0.05% preserves thousands in long-term returns. Automating rebalancing and contributions ensures consistency, and broad diversification reduces risk while helping you stay invested. On the right, increasing income can deliver a step change. Negotiating a 20% raise, switching to a higher-paying industry, or monetizing niche skills often moves the needle faster than incremental optimizations. The ideal approach is to do both, lower fees and raise income, then maintain your spending level to capture the surplus for investment. Here is a practical 30-day plan. In week 1, confirm your employer match and set contributions to capture 100% of it. In weeks 1 and 2, raise your contribution rate toward your target level and enable automatic escalations. In week 2, select low-fee index funds or an appropriate target date fund. In week 3, review expense ratios and replace funds with excessive fees, typically above 0.2%. Also in weeks 3 and 4, develop an income plan, including skill building, certifications, and negotiation preparation. By day 30, commit to directing any raise or bonus straight into your retirement accounts to prevent lifestyle creep. This mind map organizes the strategy into 4 pillars. The first pillar is tax shelters, including the employer match, maximizing 401k contributions, and using index funds. The second is retirement loading, highlighting the Roth 401k for moderate incomes, target date funds, and keeping fees low. The third is income growth via negotiation, skill building, career pivots, and side income. The fourth focuses on goals and timelines, such as building a 3 to 5 year house fund, setting an early retirement savings percentage, and maintaining an emergency cushion with cash or short-duration treasuries. The branches include concrete action items, so you can execute. Second quiz. If your income is in the mid-5 figures and you expect higher taxes later, which 401k option often makes sense? Option A, traditional 401k for the deduction now. Option B, Roth 401k to pay taxes now for tax-free later. Option C, neither, and use taxable brokerage first. Option D, only after maxing HSA and IRA. You may pause the video now to consider. We will review the answer in the next section. The best general answer for mid-5-figure income, assuming you expect higher taxes later, is the Roth 401k. You pay taxes now at a relatively lower rate and potentially benefit from tax-free growth and qualified withdrawals in the future. Always confirm with your specific tax situation, but this approach typically aligns with the long time horizon and compounding advantages. Finally, define your future by assigning time frames to each goal. Separate near-term goals within 2 years, medium-term goals of 3 to 7 years, and long-term goals beyond 10 years. If you plan to buy a home in about 5 years, use liquid, lower-risk vehicles, such as high-yield savings accounts or short-term treasury bills. If early retirement is your priority, keep increasing your retirement contribution percentage as aggressively as is sustainable. Always match the investment vehicle to the time horizon and risk tolerance. Maintain a separate taxable fund for medium-term goals so you do not disrupt retirement allocations. Use a checklist to define each target amount and date. Assign the appropriate account and vehicle, automate contributions, and review progress quarterly. Here are the core points. Prioritize tax shelters and avoid speculation. Increase contributions early and watch your fees. Focus on income growth as the main accelerator. Align investments with explicit timelines and automate contributions while reviewing periodically. To summarize, Maximize your 401k and capture the employer match before investing in taxable accounts. Favor low-cost index funds instead of individual stock selection. Consider the Roth 401k if you expect higher taxes later. Grow your income through negotiation and skill building, and invest the additional earnings. Finally, define time-bound goals and align your investment vehicles with each horizon. Thank you for watching. If this was helpful, please like the video, share it with someone who could benefit, and subscribe for more content. Comment with your next financial goal and timeline so we can support you on the journey.